Afternoon, everyone. I'm going to try to wake you up a little bit and get your attention and see if you're really interested in learning something with some takeaways on preparation for an IPO. I hope to be able to give you some valuable insight based upon our experience, not just generally with the IPO markets, but specifically in today's market. Just kind of quickly, if I can, just curious, are any of you in the process of going public or preparing for an IPO? Got one in the crowd. Okay. Thank you. So let's see if this will work with us. There we go. So I'm going to just talk to you generally about IPO readiness, and then we'll get specific in some of the pathways that are really about preparing your company. So whether you're an investor, whether you're So whether you're an investor, whether you're a company issuer, board member, there are any attorneys in the room or auditors in the room, we play a pivotal role in preparing companies to come into market. So I'm going to talk to you about our role and generally what we've learned about the value of companies being ready to execute and then to be sustainable as a public company listing in this environment. So we have taken exchange listing, which is about 4 years old now, as a unique advisory company that's really active with the issuer and sitting between them and the entire ecosystem of the small cap and microcap markets. So that includes the exchange, the investment banking community, lawyers, transfer agents, attorneys, A to Z basically in the entire ecosystem. Our focus is on a senior exchange listing. We work directly with NASDAQ, New York Stock Exchange, and the emerging exchange of the CBOE, which we've now in process of listing our first company. And the approach there, when we're working with small cap and microcap companies, is to give them access to transformational capital. Typically in the stage of development, when you're in microcap and small cap, a significant amount of infusion into your balance sheet in the way of working capital is transformational by nature. Typically, just to give you some definitions, I would call microcap $50 million to $300 million market cap, small cap $300 million to $1 billion. That's a wide berth of operating companies, giving you an idea of the range of where we work and where we focus. When doing an IPO, I think we all understand it's extremely volatile. I've taken 2 of my own companies public way before we created exchange listing, knowing that it's a 360-degree perspective. And what I mean by that is, if you're turning to a lawyer, you're going to get legal and securities counsel. You turn to your auditor, you're going to get their counsel on your audited financial statements, reporting requirements, and the like. And bankers, they're going to give you their perspective. We look at the entire 360 degrees of what a company would need to do to properly prepare for listing. We've done it ourselves. Our team exists of prior securities attorneys, investors, founders, board members, investment bankers, market makers, compliance. So we have a very unique perspective, all have been on the front line, and we bring that experience to the issuers that we work with. And of course, finally, we're very strategic. No issuer is the same. So if you're going through an IPO, we treat you as you are, as a very unique and special company, and create a strategic roadmap organized around your unique characteristics and what it's going to take to get you through the process successfully. Our model is based on 3 very simple pillars. It's a 5-10-5 program that we created, proprietary. To put some context around it, if you're a mid-cap or a large-cap company, you're likely to turn to a Deloitte, a McKinsey, an Accenture to get that guidance maybe 2 years out or ahead of an IPO. For microcap and small cap, that framework hasn't existed that I know of until we created one that we execute with our clients. And it's based on 5 pillars, 10 modules, which is part of the roadmap that we take you through, and 5 deliverables. We all live in a world where deliverables and specific outcomes drive the milestones and forward progress. And so our work is very tangible in the outcomes we create to move the companies through the process of preparation, education, and a successful listing. You know, when I first took my company public, I didn't have that knowledge base. I didn't know what to expect along the journey, and more importantly, to prepare myself for success as the CEO of a publicly listed company. So what are those first 5 pillars? Business readiness. You know, for us, that means examining your business model, looking at what is the unique characteristics of your specific business, service, or technology, focused on bringing that message to the investment community. Companies, when they're private, have a different orientation. CEOs have a different focus. Ours is looking at the business from the filter of capital markets, because that's who your audience is now coming up. Same with diligence. You know, we're preparing you ahead of what your securities counsel is going to want to see, what the auditors are going to want to see, what the investment bankers are going to want to see. And just that organization of taking a company through the process of getting their diligence organized is an arduous task at times for a private company leading into an audit. Audit's probably the most difficult, longest timeline item, as many of you know, in preparing for executing on your IPO. The diligence ahead of that, the preparation ahead of that, all very critical. And then the organization. Who's your team? Is your founder going to be the CEO and chairman? What's your C-suite look like? What does the organization look like? All the way down through lower levels, mid-levels, and C-suite, and then of course your board and your advisors. For us, it's a comprehensive look at everything that would need to be done to have the organization ready. So these are the modules. You know, we start off with that kind of deep dive. I used to be an investment banker. Any of you in the room who are bankers, you know you have to dive deep into understanding the business. What's unique about this company? Where does it stand in the competitive marketplace? Where does it stack against the environment that it's operating in, both from an operating perspective, from the size of the market, the comps, and their competitive strengths. So that by itself sets aside companies to change the messaging, change the way that their perception is from the investment community. That rolls into a deck. We've all seen them, countless decks. Some are good, some are 30 pages, some are 12 pages, they're all over. We follow a kind of a standard format focused on what is the message you want to communicate to your audience. And in this case, our first audience is the investment bank. Many of these CEOs have never pitched to or understand what the bankers are looking for. So as we're taking them through preparing the deck, we're refining the story, we're getting them organized for their first major audience, typically in our role, which is introducing them, preparing them for an engagement with an underwriter. Following the deck are the financials and the model. You know, every business has to be able to identify their metrics, key metrics, their financial performance, and then where we typically focus are those assumptions that are underlying that model. In certain cases in this environment, we're actually submitting that model to the exchange. And so it's really critical, meaning NASDAQ or NYSE or the CBOE. And they want to understand as well, where is the company going financially? What are the assumptions? What are those key metrics? We don't assume that the company understands what needs to be recorded, and often to refine, just like any, I would say, strong financial model, the underlying assumptions that are used, and not the typical 30% growth that we see in the hockey stick that everybody loves to present when they're presenting their financial model. Business diligence, business prep speaks for itself. Unfortunately, it takes a lot of time and detail to get to the point where you have a well-organized diligence room. And we find time after time that both the company and those professionals around miss certain aspects that are critical. So we try to filter through all that and organize it ahead of time to flow through and reduce the cost and the time and the efficiency when you bring in your auditors and your securities counsel. Pre-IPO financing, I could spend the entire 20 minutes talking about this. Capital stack, how much money have you raised? What does your cap structure look like? What are the valuations? How does that affect your next round? All of these components lead into the ability to present your company properly for the investment community to be able to facilitate the next round and ultimately into your IPO. Under our role, we actually often are required to participate and or facilitate a bridge round or a crossover round. Accessing significant institutional capital, you need money on your balance sheet to be able to do that. You need money to be able to affect the cost of your IPO. So we examine all these things ahead of the 12, 18, 24 months that we like to see our companies prepare prior to going public, including that rampway and that runway into the audit, which is a very significant timeline and cost. Having outside professionals that can organize the details of your financial notes, educate management around the critical subjects of derivatives and or the financial notes and all the components that are really necessary to have that full financial transparency and disclosure in an audit. I think the last thing I'll touch on are two. The banker prep and the banker selection and governance. So we're preparing these companies to present them to a banker. We want to have the best match for the bankers in the room. You're looking for a client that's ready, understands what it's going to take, and is committed to going public. Part of our role is to be the matchmaker and organize and facilitate that. Governance. We like early to put the proper governance, the committees, the boards, the necessary items so that the company can start operating as if it was already public way in advance. Our typical timeline would be 1 year in advance to work within a full governance, well-run, well-organized, well-managed company, including the board. So the deliverables we're preparing, are really based upon very fundamentals. DEC, financial model. The ability to communicate properly to the financial community, start with the bankers, start with then the analysts, start with the financial community and the investors that you want to attract. Prepare the S1, not just drafting from legal disclosure, drafting from what the company wants to tell their story. For the attorneys in the room, this is a historical document. It needs to also, in addition to the legal requirements, tell the story of the company. The company's never done this before. We like to work with them on understanding where they want to leave the readers of a prospectus, understanding and taking away what the company does and how they're unique and different. Audit speaks for itself, and of course, diligence speaks for itself. In the few minutes remaining, and then I'm happy to field any questions. In anybody preparing for an IPO, you need the proper time, resources, in this case, counsel, and or other advisors in all aspects of the IPO execution. We split the journey into readiness first, execution second, and then look at the sustainable components of being a publicly listed and traded company. So every program that we enact upon, every company is unique, requires unique execution. And obviously for us, we want to be able to save time, reduce the cost, give counsel to the entrepreneurs, to the CEOs, to their stakeholders for the most effective IPO execution, including valuation. So the better prepared you are, the better organized, the better you are able to execute, and ideally be better received by the investment community with a higher valuation. So thanks for taking the time to listen. I've saved a couple of minutes in case there's any questions that I can field. And if not, thank you very much for your time. Outstanding, world class.
Okay, next up in the symposium, the power of seasonal investing, using cycles, seasonality, and recurring patterns to enhance investment portfolio returns, with Jeffrey Hirsch, Editor-in-Chief of Stock Traders Almanac.
Thank you. Appreciate you guys coming out. Great to be down the shore where everything's all right. So let me just make sure I have this functioning. There we go. So as you said, the power of seasonal investing. I will get into my take on microcaps and small caps, but I'm going to kind of give you a crash course on seasonality. Got a bunch of slides. We're going to go fast. We're going to speed, do a little New York fast talking. And here we go. We've been on the street for 57 years. My father, late father, Yale Hirsch, who passed away at 98 years old in 21, started the Stock Traders Almanac back in 1966. The first edition was in 68 that came out. I am 57. I'm as old as the book, born, bred, weaned, raised on cycles, patterns, seasonals, et cetera, so forth. Here's some of the books. You see that super boom, 38,820. I made that forecast back in 2010 or in May with the Dow around 10,000. Here we are right at that. So that's another topic, another slide deck, another subject, and some of the places we get to appear in the current 57th edition that's out, which we give away to all our subscribers to our newsletter. My philosophy, a little flip on the Santiana quote that those who fail to remember the past are condemned to repeat it. Excuse me, I like to say that, pardon me, those who understand market history are bound to profit from it. My disciplines, everyone thinks of us as the seasonals. You heard of the January barometer, the Santa Claus rally. Those two things my father invented back in 1972. It was in the 73 Almanac. I'll get into that in a little bit. We have we just had the January barometer full month reading. So our foundation, cycles, seasonals, recurring patterns, but I look at current trends in the economy. GDP is something we're tracking right now, pretty healthy. Monetary government policy, yes, we had no cut yesterday. I'm not sure who actually thought we were going to get one. I've been talking about mid-year and maybe 3 for this year at best. Market internals, sentiment, there's some talk about breadth lately, new highs and new lows. Sentiment, I put out a post a little while ago this morning on bullish sentiment, investors' intelligence. It's getting kind of up there. Everyone's concerned, but it's amazing how long bullish sentiment can stay bullish for a long time. Just look back at 21, and you can see it on my Almanac Trader Twitter feed right now. Market ripped higher through 21. Bullish sentiment was way up there. Fundamentals and technical analysis, and we use all that in conjunction to build portfolios, generate trading signals, and our market outlooks and forecasts. And I'll show you some highlights of those things. So today's takeaway is the power of seasonality, the 4-year cycle, my forecast, the January barometer is key, and how we uncover undervalued, off-the-radar stocks, our switching strategies, and of course I always have a special offer. We'll give you that. So the 4-year cycle, amazing how the market has tracked the 4-year cycle so closely for the past 3 years since COVID. The sweet spot I've got highlighted there in green is the last quarter, the fourth quarter of the midterm year, the first 2 quarters of the pre-election year. It's just hit right on cue. The pre-election year, the strongest of the 4-year cycle, that was last year, made new highs, and you can still see it tracking very closely right now. It's a couple days old, not too bad. Maybe last week when I sent them the slides, but the pre-election year, you get this midterm bottom move where we call midterm is where bottom pickers find paradise. You see the midterm low to the pre-election year high. Dow averages about 48%, 68% for NASDAQ. You can see the S&P, the little yellow circle. Interestingly enough, the annual highs for the pre-election year often occur, or the biggest chunk of occurrences is in December, and a lot of them at the last trading day. Second to last day of the year for the S&P, third to last for NASDAQ. Here's my little buy in October circle or square and arrow. The 23 track was just right on our pre-election year pattern and the aggregate cycle, which is all years, the 4-year cycle year and the year of the decade. Everyone talks about sell in May and go away. I like to say buy in October and get your portfolio sober. Actually, right here in the back in the book on late October in the calendar says, late October is a great time to buy stocks, especially techs and small caps and microcaps. So, election year seasonal pattern, the power of a sitting president running. The market hates uncertainty. With any current incumbent sitting in office, the likelihood is that economic, market, and civic conditions will remain similar with that same administration in office. And here you can see when we have a sitting president running in the green line, 12.8% in all those years, going back to 49, which is the first full 4-year cycle after World War II. Open field, nobody running. People who have their political, ideologies talk about, somebody should replace Biden, he's so old, whatever. Maybe, but if you're along the market, if the guy who's in there isn't there, it might make everyone nervous on Wall Street. So politics aside, that's the pattern there. And again, you can see the all years in the aggregate cycle. And 24 in the pink is popping back up to the sitting president track. It's even a little bit more above that. Yesterday we had a sell-off, which, everyone sort of came to grips with the fact that we're not getting a cut in March. Sorry. But The trifecta, my January indicator trifecta, taking the Santa Claus rally, which is the last 5 days of the year, the first 2 of the new year, the first 5 days, which is an old early warning system from like the 40s. It's been around for a long time. And the full month January barometer. Remember, January barometer, Santa Claus rally is invented by the Stock Traders Almanac, my father, Yale Hirsch. Key on the one in the upper right corner, where you see the 3 years we had a down Santa Claus rally and a down first 5 days like we had this year. And then the January barometer full month comes to the rescue. It was up 1.6% for the S&P for the month yesterday. The average gain, I know it's only 3, but they're all up. The average gain for the next 11 months is, what's that, 15.1% and 19.9% for the full year. So this is bullish. However, yesterday's weakness, the fact that we're a little overbought and the internals are a little rough, and we're coming into February, the weak link in the best 6 months of the year, November to April, you know, a little bit of consolidation might be in order, but I don't suspect anything sinister. Probably be a good buying opportunity. The best 6 month switching strategy, buy in October before you sell in May. This is the pattern going back to 1950 here. I break out 1901 to 1949. A lot of people will go back before World War II and try to debunk the best months of the year, the best 6 months. But if you look here, it's basically buy in April, it's sell in harvest time. It's really driven by the, you know, agrarian economy, the farming, where the people are buying, you know, farmers are buying seed and feed and fuel and hiring people and borrowing money. And it puts money, it used to put money into the banking system and the financial system. And then when the harvest time comes and the loans come due, market sells off. Different now when we have this sort of, you know, London season economy, sell in May and go away. Coming back and St. Leger's Day is the old saw where people would sort of leave the city of London and go up to the country with Downton Abbey and go fox hunting and have horse races, and then come back in September after the St. Leger's Day stakes race, which was the last leg of the British Triple Crown, and get back to the business of the country. Now we have the sort of Labor Day to, Memorial Day to Labor Day period where I play a lot more golf, I go away, the kids are doing other things, and there's more light. We're all in the Northern Hemisphere. People are outside more as opposed to inside trading. So we see that pattern where, you know, Q4 and Q1 are stronger and Q2 and Q3 weaker. But I break out 1988 because that was just after the 87 crash when they changed the market systemically with the collars and curbs and that sort of stuff. So it works. A little bit of math showing the average gain for the the Dow in this one for the best 6 months, November to April, 7.3. Worst months, May to October, 0.8. That's from, you know, October 31st to April 30th, April 30th to October 31st. Compounding, the power of compounding, we all see that now. We all know about that. Taking a one-time $10,000 investment back in 1950 in the best months gives you a gain of $1.2 million almost versus $3,000 in the worst months. Roll a technical trigger. Everyone knows what MACD is, moving average convergence divergence, a technical momentum trigger. Increases the results to 8.8% for the best months. Turns out little gain to a little loss for the worst months, and then nearly triples the return with the power of compounding to $3.4 million versus a loss of $5,300, $5,400 rounded up. So that's the best 6 months. That's the granddaddy of our systems. I trade this. I currently own the Dow, S&P, NASDAQ, IWM right now, et cetera, so forth. I know I'm going real fast, but I wanted to get to some stuff. Seasonal sector trading calendar. This is out of page 92 in the Stock Traders Almanac. We use these seasonal patterns. You can see the big cluster of bullish sectors in October. Go figure. And we overlay this with our other analyses, macro trends, fundamentals, what the technicals are doing, and if the underlying ETF or the quarterly ETF is tracking or the index is tracking the seasonal pattern. We have a couple, you know, a whole ETF portfolio out there right now. XLE is one of the ones that we're in there. We're looking at natural gas right now, which starts in February, again, with also correlated with the commodity seasonals. So that's the main chart. But I want to get into our stock picking process because this is the Microcap conference. And I grew up in the business picking microcaps, Vancouver mining stocks, biotechs. First thing my father taught me was the price to sales ratio was key. used to grill, CEOs about the fully diluted shares outstanding if every single option or unit was exercised and all that stuff. Now, I really just look for stocks that have earnings and revenues, but I look for stocks that are off the radar, not followed by Wall Street. So we run our screen usually around the beginning of the best 6 months. We'll do it other times if opportunities present themselves. So we overlay the seasonals with a fundamental screen, looking for stocks that are exhibiting an acceleration of growth in revenue and earnings, as well as good valuations, price to sales, earnings, cash flows, margins. And then we look at analysts. We don't care what they're saying. We just want to know how many are following the stock. And we're looking for stocks that are underfollowed. Basically, if there's two stocks that are the same, all things being equal, and one of them is followed by 20 analysts, and one of them is followed by 2 or 3 or 4, whatever, we're going to go with the one that's underfollowed, because when what we see in our screens becomes apparent to the street, we get some additional push from people coming into it, and some buy ratings coming in. So we break it down into 3 different market caps: under $1 billion for small cap. One of our big winners, which I'll show you this symbol in a minute, this year's cycle was about a $110 million company, which technically is Microcap these days. Used to be larger back when I started in the 90s, but and then we have $1 billion to $5 billion is our mid cap, and then over $5 billion is our large cap. Rarely is there a mega cap in there. I don't think I can add anything to everyone else in the world on Twitter, wherever, CNBC talking about these big mega cap stocks. I just buy the Qs, if I'm going to get into that. So then we take that list, once we pare it down to these stocks that are exhibiting, this growth, acceleration of growth, and great valuations, and we look for some relative strength. We don't want any stocks that are, beating the market or lagging the market. We want to sort of humming along quietly, underfollowed, kicking off good earnings and revenue numbers, and then we'll run some technical analysis on it and look for charts that look good. I do use Market Smith at IBD. I use Zach's Research Wizard for the fundamental screen. We also have Trade Navigator as a software we look at, but I look at other charts, and then we use that technical for those technicals for buy limits and stop losses, not just some random percentage of 7 or 8% stop. We look for consolidations and gaps and things, and or pivot points and moving averages where there's a good place to enter or put a stop. And then sometimes we'll reverse it for shorts. In the summer, look for the ones that are very overvalued and losing money and that sort of thing. And basically old school fundamental and technical analysis overlaid with seasonalities. So that's our stock picking process. Small cap season. This is an updated version of what's in the Stock Traders Almanac. I've updated this recently for my members webinar and for some posts. I haven't put this out on the feed yet, but you can see the orange line. It's updated. It's found some support here. This is the ratio of the Russell 2000 versus the Russell 1000, showing outperformance of small caps versus large caps, starting here in late October. Remember I told you late October, a great time to buy tech and small caps early on. And then really hitting that low point where I've got that sort of box there in mid-December. This is what used to be called, or what's still often called, or the January effect, which is the effect of the tendency for small caps to outperform large caps in the month of January. We've seen and proven that has shifted to most of that so-called January effect taking place in the last 2 weeks in December, mid-December. A couple pages on it here in the Almanac. So really took off last year. Great trade. I still own the IWMs, which is the proxy for the Russell 2000. And then it kind of peaked early with the market. We had a hell of a rally. Bitcoin too is all over that. But it's come down quite a bit. But recently, and even today, I was just looking at Russell seems to be a little bit stronger than the large caps. It started to find some support. So maybe we've got a little bit left. Usually sort of peters out around late February, early March. So we're starting to wind down. There's a strategy we have called the Only Free Lunch on Wall Street. Another page in the book. Picking stocks making new 52-week lows on triple witching in December, sort of a old mid-December to mid-February new lows, the sort of, dogs and cats outperforming the market. It's really a dead cat bounce trade, picking up stocks sold off on tax loss selling. I'm out of all those myself. One of them I traded really nicely. Almost had a double on it from like $1 to almost $2. But you got to get in and out of those things. It's not something you want to get married to. So maybe it's over. Maybe we found some support. I'm concerned about the Russell and the small cap index, and I'm looking for some confirmation or signals from the actual price action. So I think the Fed's going to be higher for longer. I mentioned, probably mid-year. I put a couple of CME futures shots in my members webinar yesterday, and I did it earlier in the day where it was like 50-50 for March, and then and as soon as the news came out, it just flipped, and you can see the futures changing. So there's still these recession fears. I don't get it. The Fed's changed. It used to follow the bond market. Now they try to lead it. That's a whole other story. I have a quote from 81, the minutes, where the big tall guy, Volcker, thank you, was saying to the group, if the bond market goes out of the range of, get this, 15 to 21%, then we'll make some adjustment to the discount window. So that range is greater than the Fed's funds rate, whole rate is now. So just a little indication that it's a new world. 10-year was rising, but it seems to have paused. It's in that range there. Dollar's a little stronger. Geopolitics, we got a couple of hot spots out there right now. It's always an issue, but what's going on in the Middle East and Europe is definitely concerning. The down Santa Claus rally in the first 5 days. Inflation's cooled, is good. The Fed's done for sure. Growth is great. About 3% forecasted so far, estimated for Q1 after a blowout, 3.3 above expectations last quarter. Government's still spending tons of money. We got a lot of debt, but they're still pumping money into the economy. Sitting president's running, and the cycle's retracting. So we got a positive January barometer. Looks like a soft landing to me. Rate cuts probably coming year end. The economy's moderating. Probably get some softer job data, and our base case scenario is in play for. This was our forecast I put out the 21st. I'm just going to jump to the next slide. We're looking for 8 to 15%. Dow, probably a little more. S&P and NASDAQ. Weakness during Q2, Q3, and get pretty close to my super boom forecast. This is what we do in the newsletter. I'm kind of out of time, but I'll just run through these quickly. Those who understand market history, bound to profit from it. I give you, buy and sell signal. I tell you what to buy, when to buy, what price, stop limits, stop losses, buy limits. And here's a couple of highlights. Super Microcomputer was our pick in November of 2022 at $81.93. It's up, was what, 530 or something yesterday, up about 547% from our initial purchase price. We sold half at a double. That's one of our standard rules for these stocks. Sell half at a double, take your initial investment off the table, let the rest ride. So we're up at about 350% gain combined. Verco Manufacturing is our recent pick. Small cap, it's just about doubled. This was the $110 million market value stock. They make like specialty furniture for hospitality in schools or something. Doesn't matter what they do. It's what their 10Qs and 10Ks show as far as I'm concerned. This is our chart of our stock performance versus the S&P and the Russell. And if you come subscribe, you get a free almanac. There's a code there if all of you guys are interested. Anyone's interested, I have a couple books with me. If you want to take one home, I'll sign it for you and say hi. So thanks, everybody. If I have any time for questions, I'll take one. Yeah, go ahead.
No, I'm just saying if there is one.
Is there a question? Anybody? You could ask one, Phil, too. Nobody? Everything was made sense, even though I did my speed talking? All right. Thanks, everybody. Enjoy the show. Come talk to me.